Good afternoon. It's Wednesday, February 15th. I'm George Corrali, and this is the Market Minute. The stock market is off to a good start this year, with the S&P 500 rising over 7% year to date. We've had a breakaway momentum signal, which was triggered on January 12th, and we scored a win with the January trifecta, in which the first 2 days, the first week, and the month of January were all positive. These events tilt the odds in favor of positive market returns for 2023. Is the bear market over? It very well could be. Equities historically do very well at the end of midterm years and into the pre-election years. Here's a chart depicting a statistical measure of the S&P 500's overall market performance over the last 96 pre-election years. Stocks have followed a broad pattern that coincides with presidential terms. This pattern has been surprisingly consistent for the last 100 years or so. So we are in a sweet spot for equities. You can see that stocks make a strong move into July before flattening out into the end of the year. While we expect a positive year for equities, it will not be a straight shot higher. This next chart shows the fear and greed index levels over the last few years. Here you can see we've recently reached a bullish extreme, registering a reading of 77, which is the highest level since November 2021. Should you be aggressively buying stocks right now? Oh no. We wouldn't be surprised to see the market consolidate its gains over the next 2 or 3 weeks. We recommend patiently waiting for better entry points. Bonds look pretty good here, especially high-yield bonds and closed-end bond funds. We're nearing the end of the Federal Reserve's rate hiking cycle. Interest rates may actually act as a tailwind for stocks and bonds in the not-too-distant future. The higher the interest rate mountain rises, the longer the slope of positive returns that you can ride down on the other side. Additionally, credit spreads have been tightening over the last few months. Let's talk about credit spreads for a minute. A credit spread is the difference between the yield or return of two different debt instruments with the same maturity but different credit rating. When bear markets move to their final throw-in-the-towel phase, spreads widen, not tighten. For example, investors tend to purchase U.S. Treasuries during deteriorating market conditions and sell their holdings in corporate bonds. This causes the spread to widen. On the other hand, in improving market conditions, investors tend to purchase corporate bonds and sell U.S. Treasuries, causing yields to narrow or tighten. It's because in improving market conditions, there is lower credit risk in corporate bonds. So the fact that credit spreads have been tightening is another reason it appears that the bear market may be over. There is the possibility that we retest the low of 3,500 on the S&P 500 at some point, but we would estimate a 20% chance of that happening. We continue to see positive signs across the capital markets from the indicators we follow. If you should have any questions about anything we've discussed today, please don't hesitate to contact us. And if you think this type of information would be beneficial to anyone you know, please share this video with them. As always, we are monitoring market conditions and your portfolios closely, and we'll be sure to update you if and when needed. Thanks for tuning into the Market Minute. I'm George Corrali. We'll see you back here soon.